A very good evening to my dear students. Today, as I promised to you that I will be bringing 50 high priority case study questions. So today we will start off with the topic that is ethics questions, case study based questions on professional ethics, as well as I have brought the answers with them in the format which ICAI wants you to write so that you can fetch a marks there. Here, if you write the answers in this way, which way I am showing you, you will fetch more marks in every question. And as well as professional ethics is not a difficult but it's very interesting part, as because it is the ethics which you're going to carry forward in your life, because whether you are doing practice or in service, whatever you do, you have to follow the ethics. Okay, so you pay attention to the each and every question, how I am writing and what are the things which we have to follow. Once you deal it in a nice way, you will never forget. Okay, let's start off. These are the questions, high priority questions, case study questions, which are likely to come in 2026 examinations based on the repetitive concepts. Okay, let's start. First, I will discuss with you how to write these answers in the examination. First, what will you do? Every ethics, you will write the relevant provision, which is relevant for that particular case study. Then, facts of the particular case, which is given to you. Then, application of that provision to that fact, that question which is given. Then, derive the conclusion from therefrom, so that you can fetch marks. Every point has marks. Okay. Then, use expressions such as per clause 8, 9, whatever, of part 1 of the first schedule to the Chartered Accountants Act 1949. If you start your answers in this way, rather than writing yes, no in that way, you will fetch more marks. Okay, again, accordingly, the content of Mr. X amounts to professional misconduct. If you frame your answers in this pattern, it looks more professional and rather than general explanation. Okay, so follow the format of writing. See how I'm discussing the questions one by one. All they have been formatted in the way which you will fetch more marks. Okay. First case study, incoming auditor and previous auditor. MS Brighton Company, Chartered Accountants, okay, were appointed as the statutory auditors of Zenith Limited. MS Rao and Company, the previous auditors, had audited the company for the preceding 5 years. So here the incoming auditor is MS Brighton Company Limited, right? And MS Rao and Company is the previous auditor who audited the company, that is Zenith Limited, for 5 years, preceding 5 years. Before accepting the appointment, Bright and Company, that is the incoming auditor, telephoned Rao and Company, that is the previous auditor, to inform them that Zenith Limited proposed to appoint Bright and Company. Okay, as its new statutory auditors. During the call, Rao and Company stated that they had no objection. Okay, Brighton Company then accepted the appointment immediately. So, Brighton Company, that incoming auditor, telephoned to Mr. Rao and Company, that previous auditor, about that Zenith had appointed them the statutory auditors. And during the call, Rao and Company, previous auditor, had said that he had no objection. So now, in this case, the incoming auditor accepted the appointment. So, as per the case, advise whether Brighton Company have committed professional misconduct. Okay. Now, the relevant provision. First, see Clause 8 of Part 1 of the first schedule of the Chartered Accountants Act 1949 provides that a chartered accountant in practice is deemed guilty of professional misconduct if the member accepts a position as auditor previously held by another chartered accountant without first communicating with the previous auditor in writing. Though here the pressure is on the word writing. Okay, so clause 8 of Part 1 of first schedule says that the communication between the previous auditor and the incoming auditor should be in writing. So application to the particular case, what is said? Brighton Company communicated with Rao and Company only by telephone. The requirement is written communications. Oral communication cannot substitute for the prescribed written communication. Okay. Now from there we derive the conclusion. What conclusion we derive at? Brighton Company would be guilty of professional misconduct under clause 8 of part 1 of the first schedule. ICAI clarified that merely informing the returning auditor by telephone is insufficient. Okay. If you write your answer in this way, you will going to get full marks. Communication after acceptance. Suppose CAX was appointed statutory auditor of ABC Limited on 15th of September. He accepted the appointment on the same day. On 18th September, he sent an email to the previous auditor informing him about his appointment. CAX argues that since he ultimately communicated with the previous auditor, there is no violation. So here CAX was appointed on 15th September. He accepted the appointment on the same day, that is on 15th itself he accepted. On 18th, 3 days after that, he sent an email to the previous auditor informing him about his appointment. So and now after that, Mr. X argues that he has ultimately communicated to the previous auditor. There is no violation. So discuss the case. Let's see. Key principle, clause 8 of the part 1 of the first schedule requires the incoming auditor to communicate with the previous auditor before accepting the position. Okay, in the given case, CAX accept the appointment on 15th September and communicated only on 18th September. Okay, so application of the case, therefore the communication was made after acceptance, right? And hence it does not satisfy the requirement. So conclusion drawn from there, CAX would be guilty of professional misconduct under clause 8 of part 1 of the first schedule. Right, you can understand now how you have to write the answers. Now, communication by registered post. CA was appointed as auditor of PQR Limited. Before accepting the assignment, he sent a letter to the previous auditor by ordinary post. The previous auditor denied receiving the letter. CA produces a copy of the letter but has no proof of delivery. Comment on the particular thing. Okay. So here in this case, he has sent a previous letter an auditor, previous auditor letter, but it was through ordinary post, and he had no proof of delivery. So comment on this. Key principle, the incoming auditor is required to communicate with the previous auditor in writing before accepting the assignment. So it should be in writing, it should be before accepting appointment, and the communication should be made in a manner which provides positive evidence of delivery. So evidence of delivery is also a prerequisite. Okay. So application of the case, mere posting of letter without evidence that it reached the previous auditor may not establish effective communication. So it can be considered that communication was not done. Conclusion derived from this case, CAA has not adequately established compliance with the requirements of the communication and may be held guilty under the clause 8 of the part 1 of the first schedule. ICAI has specifically emphasized the importance of evidence of delivery, that is post by registered post. If you send it by registered post, you will get an acknowledgement card, and that will be a delivery. Effective communication can be established only if you have positive evidence of delivery, right? So it has to be posted by registered post. Statutory audit of a bank. Question case study number 4. CR is appointed statutory auditor for Nationalized Bank. He argues that communication with the previous auditor is unnecessary because the appointment is made in accordance with the banking framework and not by an ordinary private company. Comment on this case. Okay, here he is appointed by a statutory auditor of a bank, Nationalized Bank. He argues the communication of the previous auditor is unnecessary because appointment is made in accordance with the banking framework and not by ordinary private company. So what does it say? Comment. The requirement under clause 8 of part 1 of the first schedule is not restricted merely to private companies. The council has clarified, right? Has clarified that communication with the previous auditor is applicable to audits of nationalized banks and other banks as well as government agencies also. So it is not only for, it is not restricted merely to private companies. It has also for banks, nationalized banks and other banks as well as government agencies also. So it is valid for all the cases, whether it is a nationalized bank, whether it is other banks or it is a government company, not only restricted for private companies. So conclusion we are deriving from here is CR is required to communicate with the previous auditor in writing before accepting the audit assignment. Failure to do so would attract professional misconduct under clause 8 part 1 of first schedule. Tax auditor. CAP has been appointed as a tax auditor of XYZ Limited. The statutory audit is being conducted by CAQ. CAP accepts the tax audit assignment without communicating with the CAQ, stating that tax audit is different from statutory audit. Is CAP correct? Whenever this type of questions come in our examinations, we just get confused of what to write. Okay, so take this in the mind. Here, CAP has been appointed for tax auditor. Okay, XYZ Limited, and XYZ Limited statutory audit was conducted by CAQ, but PA accepted it because he thought that he is conducting statutory audit. I am doing tax audit. Okay, stating that the tax audit is different from statutory audit. Is CAP correct? Key principle: the requirement of communication with the previous auditor applies to various audit assignments. ICAI has clarified that communication requirements may apply to statutory audit, tax audit, internal audit, concurrent audit, and other audit assignments, subject to the applicable circumstances and council directions. Right. So conclusion, CAP cannot simply avoid the requirement mainly because the assignment is a tax audit. You should comply with the applicable communication requirements before accepting the assignment because it is for statutory audit, tax audit, internal audit, concurrent audit, and other audit assignments, right? And subject to the applicable circumstances and council directions. Unpaid audit fees of previous auditor. MSA and Company are the previous statutory auditors of LMN Limited. The undisputed statutory audit fees remain unpaid. So there is undisputed statutory audit fees remain unpaid. LMN Limited approaches a BN Company for appointment as new statutory auditors. The management tells B and Company that the unpaid fees are a matter between the company and A and Company. B and Company accepted the assignment. Discuss. यहाँ पे in this case, what happens? Element Limited was audited. The statutory audit of Element Limited was MSA and Company. Undisputed statutory audit fees. There's not a dispute among them, but the audit fees still remained unpaid. Okay, and now Element what has they done? Element Limited approached BN Company for appointment as a new statutory auditor, and to the management tells BN Company that the unpaid fees are a matter between the company and A Limited. There is no dispute. So, and now BN Company accept the assignment. Discuss the case. Key principle: the council guidelines provides that a member in practice should not accept appointment as auditor of an entity where the undisputed audit fee of another chartered accountant for statutory audit remains unpaid. Undisputed audit fee of another chartered accountant still remains for statutory audit still remains unpaid. In that case, council is given guidelines that not to accept appointment as an auditor. Okay, in this present case, the previous auditor's statutory audit fees are undisputed and remains unpaid. So conclusion from here, B and Company should not have accepted the audit assignment while the undisputed audit fees of the previous auditor remains unpaid. The conduct would attract professional consequences under the applicable ICAI guidelines. Okay, according to the ICAI guidelines, it will be attracting professional consequences. ICAI disciplinary material has specifically considered this issue. Validity of appointment. ABC Limited appoints CAM as statutory auditor. CAM accepts appointment without ascertaining whether the requirements relating to appointment of auditor under the Companies Act 2013 have been complied with. He argues that since the shareholders appointed him, he need not make any further verification. Okay. So, a statutory auditor of ABC Limited, Mr. M, have been appointed, and Mr. M has accepted the appointment without ascertaining whether the requirements leading to appointment of auditor under the Companies Act 2013 have been complied with or not. And the argument which is putting here that shareholders have appointed him, so he did not make any further verification. Comment on the case. Key principle here: validity of appointment. Clause 9 of Part 1 of first schedule requires a member in practice to ascertain whether the requirements relating to appointment of auditor have been duly complied with before accepting the appointment. The responsibility is therefore not discharged merely because the company informs the auditor that he has been appointed. So, what does clause 9 says? That clause 9 of part 1 of the first schedule requires a member in practice to ascertain whether the requirements relating to appointment of auditor have been duly complied with before accepting the appointment. The responsibility is not therefore not discharged because it has been Mr. M has been appointed, Mr. C.M. has been appointed as a auditor by the shareholders. Okay. So conclusion derived from this case is CAM would be guilty of professional misconduct for accepting the appointment without first ascertaining compliance with the applicable statutory requirements. ICAI's own illustrative material specifically links clause 9 with verification of the statutory appointment requirements. So statutory appointment requirements have to be seen or verified by the auditor who is being appointed by a company for its statutory or audit. So you have to be very cautious. Auditor appointment and both clauses. Okay, now till now we were doing of one clause affected. Now let's see if two clauses affect. CX is appointed auditor of DEF Limited. He neither communicated with the previous auditor nor verified whether the company has complied with the requirements related to this appointment. Okay, how you are going to deal with such a question if there are two provisions attracted? Identify the professional misconduct involved. Okay, here the two clauses are attracted. Key principle. Two separate requirements are attracted. Clause 8, part 1 of first schedule, communication with the previous auditor in writing before accepting the position previously held by him, and clause 9, part 1 of the first schedule, ascertaining whether the requirements leading to appointment of auditor have been duly complied with. In the applicable case, okay, what he has done, two separate clauses. Neither did he inform the previous auditor or communicate communicate with the previous auditor in writing about his appointment, nor did he verified whether the requirements of ascertaining whether the requirements leading to appointment of auditor have been complied by the company as per Companies Act 2013. So conclusion derived from there will be, since CAX failed to comply with both requirements, he will be guilty of professional misconduct under clause 8 and clause 9 of part 1 of the first schedule. This is particularly important, I say style combination case, because this type of questions comes in your examinations. Okay, percentage of turnover as audit fee. Okay, as a manufacturing company offers CAZ an audit fee equal to 0.5% of its turnover. CAZ accepts the proposal because he believes that a percentage based fee is always permissible and both parties agree. According to CAZ, what is there? If both parties are agreeing to the fact, then it can be taken. Okay, and they have manufacturing company says that they will fix the audit fee of the CA according to 0.5% of its turnover. Let's see how to comment on this. Key principle. As per clause 10 of part 1 of the first schedule, a chartered accountant in practice shall be deemed guilty of professional misconduct if he charges or offers to charge fees based on a percentage of profit or contingent upon findings, results of professional work. Whether it is based on the profit or contingent means if it happens then he will be getting, that is contingent. It can happen, it cannot happen. Okay, contingent upon findings, results of professional work, except where specifically permitted. Regulation 192 of the Chartered Accountants Regulations provides specified exemptions, except that the exceptions are there, though except those exceptions which are given under Regulation 192 of the Chartered Accountants Act. Otherwise, then a chartered accountant cannot be given a fee which is deemed to be based on some profit, percentage of profit, or which is contingent upon the findings or results of the professional work. Okay, so application for an auditor of a company, the permitted basis may include the prescribed basis such as the paid up capital, working capital, gross or net or profits, subject to the applicable provision. If the provisions are under Regulation 192 of the Chartered Accountant Regulations Act and where it is applicable, in that case, except that, it cannot be applied. CAZ cannot merely rely, this is the conclusion, on mutual agreements with the client. He must ensure that the fee arrangement falls within the permissible statutory or regulatory framework. If it is within the statutory or regulatory framework and it falls under Regulation 190 of the Chartered Accountants Act, then it can be permitted. It cannot be merely on mutual agreement between the client and the chartered accountant. Question number 10. Contingent professional fees. CAP agrees to charge rupees 5 lakh only if the tax appeal filed by the client is decided in favor of the client. If the appeal fails, no fee will be charged. Comment. Answer for this: a professional fee which is contingent upon the result of outcome of professional work is generally prohibited under the applicable provisions. So clause 10 of part 1 of the first schedule read with regulation 192 restricts such arrangements subject to specified exceptions. If that company falls under that exceptions, or that framework is applied, regulatory framework is applied, in that case only it will be accepted. Otherwise it cannot be based on that basis. If the framework applies for such payment, specified exceptions. Okay, so the proposed fee arrangement is not permissible unless it falls within the specifically permitted exception. Okay, always remember contingent professional fee is falling under the clause 10 of part 1 of the first schedule, which clients cannot give the chartered accountant fee which is contingent upon the professional work, except if it falls under regulation 192. Such arrangements subject to specified exceptions can be allowed. CA in other business. A CA is full-time practicing chartered accountant. He starts a retail clothing shop business in his own name without obtaining any permission from the council. He continues to hold his certificate of practice. And he is holding the practice certificate practice, as well as he has opened a retail shop, clothing shop also. So he is doing the both together. So advice. Clause 11 of Part 1 of the first schedule provides restrictions on chartered accountants in practice engaging any other business or occupation other than the profession of accountancy. So, other than the profession of accountancy, he cannot engage in any business or occupation, subject to specified exceptions. Okay, a CA may engage in permitted activities, and certain activities may be undertaken with the required permission. So, permission will be given if the activities are under the activities which are allowed and also undertaken with the required permission, right? So conclusion for this case will be Mr. CA cannot freely undertake another business merely because he continues to hold his certificate practice. He must comply with the applicable provisions and obtain permission wherever required. Permission he has to take from the council, permission for continuing the business. Okay, if they allow him, then only he can do it. Non-executive director. CR, while continuing practice, is appointed as non-executive director of XYZ Limited. He is not involved in day-to-day management and does not receive salary as an employee. Neither his salary nor he is in the day-to-day activities. Okay, so can he is appointed as a non-executive director? Is the appointment permissible? Okay, non-executive director. Key principle, a chartered accountant in practice is generally restricted from engaging in business or occupation other than the profession, subject to specified exceptions. One recognized exception permit a CA to practice is to become a director of a company other than a managing director or full-time director, subject to the prescribed conditions. Well, subject to prescribed conditions means he can only become a non-executive director. He cannot be a whole-time director or a managing director, and neither can he take part in the day-to-day operations of the company. So conclusion derived from here is appointment as a non-executive director may be permissible provided the conditions under the applicable provisions are satisfied and there is no prohibited conflict with his professional assignment. His professional assignment is not going into conflict with it. ICAI has specifically recognized the non-managing, non-whole-time directorship as exception, so it is allowed. Directorship where CA is auditor. Okay. CAX is a partner in a firm. Here CAX is a partner in a firm which he is a statutory is a firm which is a statutory of PQR Limited. So statutory is a partner in a firm which is statutory of PQR Limited. Okay. CX proposes to become a non-executive director of PQR Limited. Okay. He argues that since he will not participate in day-to-day management, there is no issue. Okay. Here is what is happening. CX is a partner in a firm. Okay. Which is a statutory auditor of PQR Limited, right? PQR Limited is there where he is also is a partner in a firm where he is the statutory auditor of that company is there. Okay, and now he proposes to become non-executive director of PQR Limited. He argues that since he will not participate in day-to-day management, there is no issue. Comment on the fact. Key principle, the permission of a CA in practice to become a director is subject to prescribed conditions. Okay. In particular case, the relevant exception does not permit the CA to become such director where he or his partner is interested in the company as auditor, as applicable under the professional provisions. Okay. For this case, further independence considerations must also be examined. Here, Mr. X is a partner in a firm. For example, we are holding it as a XYZ Limited. Okay, and XYZ and Associates. Okay, and there Mr. X is also partner with another member who is a Mr. Y, who is a partner in the firm. So Mr. X who got the CX who got the audit work for this company is saying that since he is not interested or nor is he going to do take part in day-to-day work of the operations of the company, he can be a non-executive director. But here the independence constitutions come into case because independence is attracted because he himself or anyone who is partner of the firm where he is working is interested in the company. Okay, so CX should not accept the directorship in circumstances where the applicable restriction relating to interest as auditor is attracted, because Y, who is also in the same firm, is auditor of this firm of the same company where he is becoming the director. So he cannot take the directorship because he or anyone of his firm where he is there partner or he himself is a auditor of the same firm, he cannot become the director because independence considerations have to be taken into consideration. Teaching assignment. CM is in practice and accepts teaching assignments at a coaching organization for 30 hours every week. He claims that teaching is allowed as for chartered accountants and therefore no restriction. Comment on this topic. It is very important. Okay. Teaching and teaching is one of the activities which may be permitted to chartered accountant in practice subject to applicable conditions and permission requirements. ICAI has prescribed conditions related to teaching activities, including limits on direct teaching hours. Okay, so CAM must assume unrestricted permission merely because teaching is a permissible activity. Though it is a permissible activity, but you have to follow the permission, how much hours have been allowed for. He must comply with the applicable council requirements and prescribed teaching hours limit. So he cannot take 30 hours because since he is a chartered accountant and since it is he is in chartered accountant practice and since it is allowed to teach, he cannot go beyond the limit which has been prescribed by ICAI. Soliciting professional work. Say P distributes pamphlets outside a corporate park stating best chartered accountants in Bhubaneswar, okay, or guaranteed tax savings, lowest professional fees. The pamphlets contain his mobile number and his list of services which he is performing. Comment on the conduct. Soliciting professional work. Okay. Chartered accountant in practice must comply with the restrictions on advertisement, solicitation, and canvassing of professional work. Okay, this is soliciting professional work. The statements best chartered accountant, guaranteed tax savings, and lowest professional fees are promotional claims and are designed to solicit professional work. This is simply saying that the firm wants to solicit professional work. Okay, so it cannot be said. So conclusion we can draw from here: the conduct is inconsistent with the professional restrictions and may amount to professional misconduct. Okay, so to the applicable all the answers we will first say what the key provision which is applying there, then the application to the case, then come to the conclusion. I have come to the just first I have shown you. Now if every answer I will show you, then it will take you a long time. So I am telling it to how to write. First say the provision which is attracted, then say to the applicable case. Okay, then derive the conclusion. So the statements being chartered accountant, guaranteed tax savings, and lowest professional fees are promotional claims and are designed to solicit professional work. So this will not be allowed. The conduct is inconsistent with the professional restrictions and may amount to professional misconduct. Okay. Social media advertisement. A CA posts on Instagram. Hire us today. We are the #1 audit firm in the city. 100% guaranteed compliance. Special discount for first 20 clients. He argues that social media did not exist when traditional rules were framed. Discuss. The medium of communication does not by itself remove the professional obligations applicable to our chartered accountants. Okay, when the provisions were made, maybe the social media was not there. Okay, but the medium of communication cannot become itself remove the professional obligations applicable to chartered accountants. The CA must comply with the applicable ICAI provisions governing advertisement, solicitation, and professional communication, irrespective of whether the communication is through print media, website, or social media. So, whether the media is in this particular case, let's say this is the key provision. Now comes the applicable case to the particular case. He is saying since the social media was not then when the provisions were made, framed, so he can do this type of advertisement through the Instagram. Okay. Conclusions we derive from here is the promotional and comparative claims and discount based solicitation would require examination under the applicable professional rules and cannot be justified merely because they were made through social media. So, whatever media they are using, it cannot go cross the provisions which are framed in the CA provision, the provisions of the Chartered Accountants Act 1949. Okay. So cannot claim, C cannot must comply with the applicable CIC provisions governing advertisement, solicitation, and professional communication. Right? What you are going to communicate, that has to be according to the provisions of the CH. A CA firm designs a distinct golden logo containing the firm's initials and used in its visiting cards, letterboards, invoices, and other official office signboards. Comment: use of logo. The Code of Ethics places restrictions on use of logos, monograms by CA firms. ICAI has clarified the use of a specific logo, monogram on professional stationery and display material is prohibited, subject to the permitted common CA logo in accordance with the council guidelines. The logo which is permitted is given there. Conclusion: the firm's distinctive logo would not be permissible merely because it is used for branding purposes. For branding his own firm, he cannot use such logos. Only the logo which has been permitted by CA common law that can be used. Okay. But then also this is clarified. ICAI has clarified the use of a firm specific logo, monogram on professional stationery and display material is prohibited. Okay. Claim of ISO certified. CA and company obtains ICO certification. The firm prints ICO certified CA firm on its visiting cards and letterboards. Comment on this particular case. Okay. Obtaining ICO certification itself is not prohibited. You can obtain a ICO certification. However, ICAI has clarified that the member cannot use expressions such as ISO certified or professional documents, visiting cards, or signboards in a manner prohibited by the code. So, conclusion: the certification may be obtained, but its visual display or its display use must comply with ICAI professional guidelines. It cannot cross the guidelines. Fee sharing with a non-CA. CA agrees to pay 20% of every audit fee received to a business consultant who introduced clients to him. The consultant had no professional qualification as a chartered accountant. Comment. So here, fee is being shared with a non-CA, right? Fee sharing with non-CA. A chartered accountant in practice is subject to restrictions concerning sharing of professional fees and payment of commission or gratification for procuring professional work. The argument must be tested against the specific provisions and permitted exceptions. Application. Payment of a percentage of professional fees to a person merely for procuring clients is not permissible where it falls within the prohibited arrangements. So conclusion, we can say a CA would be liable for professional misconduct if the arrangement is prohibited under the applicable provisions. Canvassing through an agent. CR appoints a marketing agent and agrees to pay him 10,000 every new audit client obtained through its efforts. The agent approaches companies and tells them that CAR will provide cheaper and better audit services. Discuss. The arrangement involves active solicitation, canvassing of professional work, and payment of considerations for procuring professional assignments. Such conduct is contrary to the professional standards applicable to a CA in practice, where it falls within the prohibited activities. So, conclusion we can draw from here: CAR would be exposed to professional misconduct proceedings. Confidential client information. During an audit, CA obtains confidential information that his client is planning to acquire a competitor. Before the acquisition is announced, CA tells his friend who purchases shares of the competitor. Discuss. Okay. So during a audit, CA obtains confidential information that his client is planning to acquire another competitor's shop business. Before acquisition is announced, acquisition is not announced. Before that only, he told his friends about the acquisition and who purchased the shares of the company. Discuss the case. Here, the key principle attracted is the fundamental ethical principles of confidentiality requires a professional accountant to respect information acquired during professional and business relationships. The CA must not use confidential information for his own advantage or for the advantage of a third party. Application to particular case. In addition, the conduct may attract consequences under the applicable laws depending on the nature of the information and transaction. So, conclusion we can draw: CA has violated the principles of confidentiality and may also face other legal consequences as applicable. Disclosure to another client. CAX audits two competing companies. The management of company A asks him whether company B has recently entered into a major contract. CX discloses details because company A is also his client. Okay. Two competing companies and he is the auditor of both the company. Okay. Now he is disclosing information about the company to the other company client. Okay. Comment. Key principle: the fact that both entities are clients does not permit disclosure of confidential information relating to one client to another. The principle of confidential requires the CA to protect information obtained through professional relationships. Conclusion we can say: CX should not disclose confidential information of company B to company A without appropriate authority of legal professional basis for disclosure. Conflict of interest. CM advises company X in a dispute against company Y. Okay. Subsequently, company Y approaches the same CA for advice in the same dispute and offers a substantially higher fee. CAM accepts. So there are two parties dispute, Mr. Company X and company Y. Mr. CM advises company X in a dispute, okay, against company Y. Now, company Y approaches the same CA and offers the highest fee. Can CAM accept the case? The situation creates a serious conflict of interest and threatens objectivity. A professional accountant is required to identify, evaluate, and address conflicts of interest. To the case application, where appropriate safeguards cannot reduce the threat to an acceptable level, the professional should decline or discontinue the engagement. Here, the professional should see where it is going against his professionalism. Okay, where appropriate safeguards cannot reduce the threat. Safeguards are not avoiding the acceptable level of threat. In that case, the profession should decline or discontinue the engagement. CAM should not accept the engagement merely because company Y offers a higher fee. Conflict of interest case. Okay. Client gift. After completion of a statutory audit, the managing director gives the auditor an expensive luxury watch worth rupees 2 lakhs. As a thank you gift, the auditor accepts it. Okay. Key principle: acceptance of gifts or hospitality from an audit client may create a self-interest or intimidation threat and may compromise objectivity. Here, the objectivity is compromised, threat to intimidation threat is there. Okay, and here it's creating a self-interest where the gift is not clearly trivial and inconsequential. The auditor should not accept it. Conclusion we can come: acceptance of an expensive gift from the audit client is inappropriate and may result in violation of the applicable ethical requirements. Financial interest in audit client. CAA is proposed to be appointed auditor of XYZ Limited. He owns a financial interest in XYZ Limited of a nature amount which falls within the statutory disqualification provisions. He states that he will not participate in the audit personally and his audit team will perform the entire work. Okay. What it is showing that he is CA is appointed auditor of XYZ Limited. He has some financial interest in the firm, a nature amount which falls within statutory disqualification. But what he's saying that he will not take part in the audit work, but his team will perform the entire work. Comment. Eligibility and independence are not determined merely by whether the CA personally performs the audit work or not. Where the financial interest falls within the statutory disqualification prescribed under the Companies Act 2013, the person cannot act as an auditor. Conclusion: delegating the audit work to a team does not cure the statutory disqualification. CAA should not accept the appointment. Okay. Relatives' financial interest. CAP is appointed auditor of ABC Limited. His spouse holds a financial interest in ABC Limited. The interest is within the limit prescribed by the applicable law. CAP argues that investment belongs to his spouse and therefore cannot affect his eligibility. Okay. So in this case, what is happening? CAP is appointed as the auditor of ABC Limited. Okay. Now his spouse holds a financial interest in ABC Limited. Okay, investment is limited. The interest is within the limit prescribed by the applicable law. Now CP argues that the investment belongs to his spouse, not to, therefore he is not affected. So discuss the case. The auditor's eligibility is determined with reference to the statutory provisions governing financial interests of the auditor and specified relatives. The fact that the investment legally belongs to the spouse does not automatically eliminate the statutory consequences where the spouse is specifically covered by the law. What does it mean? The auditor's eligibility is determined with the reference to statutory provisions, okay, governing financial interest of the auditor and specified relatives. Who are specified relatives? The fact that the investment legally belongs to the spouse does not automatically eliminate the statutory consequence where the spouse is specifically covered by the law. So conclusion, we derive it. CAP must examine the prescribed limit and nature of interest. If the interest falls within the prohibited category, okay, he would be disqualified from acting as an auditor because spouse is relative. Okay, disqualified from acting as an auditor. And if it falls beyond the prescribed limit, then if it is within the prescribed limit, it can be taken. But if it falls beyond the limit, then it will be qualified from acting as an auditor. Independence and outstanding fees. An audit client has not paid the auditor's fees for 2 previous years. The auditor continues the audit and plans to recover all dues after completion of the current audit. Discuss the ethical issue in this case. Independence and outstanding fees. Key principle: significant overdue fee may create a self-interest threat to independence because the auditor may effectively have a financial interest in the client. The auditor should evaluate the threat and apply appropriate safeguards. Application: where the threat cannot be reduced to an acceptable level, appropriate action including withdrawal may need to be considered. In this case, conclusion will be the auditor should not ignore significant overdue fees while assessing independence. So independence have to be seen, because if he has not received fees and for the fees is conducting this, it is a threat to his independence. Okay, so it cannot be accepted. Auditor providing management decisions. During an audit, the CFO asks the auditor to select which accounting policy should be adopted because the auditor knows accounting better than management. The auditor chooses a policy and instructs the accounting team to implement it. Comment. Management is responsible for making management decisions and preparing the financial statements. The auditor should not assume management responsibility because doing so creates a self-review and management responsive threat to independence. So conclusion in this particular case, conclusion is that the auditor should advise management regarding accounting alternatives when where permitted, but should not take the management decision on behalf of the client. He cannot take management decision on behalf of the client because in that case it will be taken as he is doing the self-review work, and management responsible threat to is threat to independence. Auditor preparing financial statements. A small company asks its statutory auditor to prepare its financial statements. The auditor prepares all accounting entries, finalizes the financial statements, and subsequently audits the same statements. Comment. Preparation of financial statements for an audit client may create a self-review threat because the auditor would subsequently be auditing work performed by himself or his firm. The auditor must evaluate whether the applicable independence requirements permitted the service and whether adequate safeguards can be applied. Application of the case for entities subject to stricter independence requirements, the relevant provision must also be considered. So conclusion, we can say the auditor cannot automatically provide the service merely because the client requests it. Okay, so if he is doing so, then in that case it will be a self-review threat. Okay, so it cannot be done. Auditor accepting an assignment because of personal relationship. The promoter of ABC Limited is the auditor of close friend. The auditor accepts the statutory audit despite admitting that he is likely to overlook minor errors because of his friendship. Comment. Key principle: a close personal relationship may create a familiarity threat to objectivity and the independence. If there is a familiarity threat to objectivity and independence, okay, it is a close relationship, So it is a friendship. So in that case, it will be a threat to family threat to objectivity and independence, and the auditor should refrain from it. Okay, the auditor must identify and evaluate the threat and determine whether appropriate safeguards can reduce it to an acceptable level. Okay, application case, if the threat cannot be adequately addressed, the assignment should not be accepted. It has to be refrained. The auditor has to refrain from it. Okay, so conclusion: CX cannot justify acceptance merely because the client is a friend. If there is a familiar threat to the objectivity and independence of his work, then he should not take the assignment. Auditor and fraud. During the audit of PQR limit, the auditor discovers that the CFO has manipulated revenue figures. The CFO promises that the amount will be reversed before the annual general meeting and asks the auditor not to report the matter. The auditor accepts the assurance and issues an unmodified opinion. Okay. The auditor and fraud. Okay. Key principle: the auditor cannot ignore identified fraud merely because management promises to reverse the transaction later. The auditor should evaluate the nature and extent of fraud, assess its effect on the financial statements, perform appropriate audit procedures, communicate appropriately with those charged with governance, consider reporting requirements under applicable law, and determine the effect on the audit opinion. Okay, he cannot give a opinion just basis on that. The management said that the CFO said that he will reverse the transactions. Okay, so conclusions drawn from here: the auditor's decision to ignore the identified fraud and issue an unmodified opinion without appropriate evaluation may result in professional and statutory liability against the auditor, because he is doing something which is going beyond the liability of the auditor also. So it is not only going to give professional misconduct, it is also going to raise penalties against him. Management override. The auditor notices that the managing director personally approved several unusual journal entries at the year end. The entries significantly increase the revenue of the company. Okay. The auditor accepts the explanation that the MD has full authority. Comment. Key principle: management override of control is significant fraud risk. The auditor should evaluate unusual journal entries and adjustments, particularly those made near the end of the reporting period. Okay, here it has been done near the reporting period, end of the reporting period, as well as done by the CFO management. Application to the case: the auditor cannot treat the management director's authority as a substitute to audit evidence. Cannot. If the managing director has authority, he can do anything. No, he cannot take out any, because it is not it is not a substitute for audit evidence. Okay. Conclusion we draw from here: the auditor should perform appropriate procedures and evaluate whether the entries result in material misstatement or fraud. Management representation. The auditor asks management whether any fraud has occurred. Management gives a written presentation stating that there is no fraud. The auditor performs no further procedures. So management is giving representation and the auditor is accepting it. Okay. So is the auditor justified? No, management presentation is an important source of audit evidence but cannot replace other audit evidence where additional evidence is necessary. Application to the case: the auditor should exercise professional skepticism and perform appropriate audit procedures. From the starting of the audit to the end, he should keep professional skepticism. That there is a likelihood of fraud. If he feels that there is a fraud can be there, he should use his professional judgment. Okay. So conclusion we draw from a blind reliance upon management presentation is inappropriate and may expose the auditor to professional liability. Audit assistant's error. An audit assistant fails to verify material balance. The auditor signs the audit report without reviewing the working papers. When the error is discovered, the auditor argues that the assistant was responsible. Comment. The auditor may delegate work but cannot delegate his overall responsibility for the audit opinion. He is required to properly direct, supervise, and review the work performed by assistants. He may delegate the work to his assistants, but he cannot delegate his overall responsibility to the audit opinion. So, conclusion drawn from there: the auditor cannot escape responsibility merely because the error was committed by audit assistant, because he can delegate the work to his assistants, but he cannot delegate the responsibility for audit opinion. Audit evidence not obtained. The auditor is unable to obtain sufficient appropriate audit evidence regarding inventory because management denies access to warehouse. The possible effect is, nevertheless, the auditor issues an unmodified opinion because he cannot access the warehouse because management has denied. He cannot give an unmodified opinion. Comment. Audit evidence not obtained. Key principle: the auditor is required to obtain sufficient appropriate audit evidence. Where there is a limitation on the auditor's ability to obtain evidence, the auditor should evaluate its effects on the financial statements and his audit opinion. So, applicable case: where the possible effects are material, the auditor should consider the appropriate modification of opinion in accordance with the applicable standard in auditing. Okay. Where the possible effects are material, okay, the auditor is required to obtain sufficient appropriate audit evidence. Where there is a limitation of the auditor's ability to obtain evidence, the auditor should evaluate its effects on the financial statements and audit opinion. Application: where the possible effects are material, the auditor should consider the appropriate modification of opinion in accordance with the applicable standard on auditing. Right? Conclusion: we can say issuing an unmodified opinion without appropriately addressing the material limitation may result in professional liability. So what does it say? Audit evidence not obtained. Okay. So where the possible effects are material, the auditor should consider the appropriate modification of opinion. He cannot give an unmodified opinion basing that the management has given limitations on achieving the or obtaining the evidence. Okay, so issuing an unmodified opinion without appropriately addressing the material limitation may result in professional liability. Civil liability for negligence. The auditor failed to perform basic verification of receivables. The financial statement showed receivables of rupees 10 crore, whereas actual recoverable receivables were only rupees 3 crores. The company suffers a significant loss and sues the auditor. Explain the auditor's potential civil liability. Civil liability for negligence, what happens? Here the auditor failed to perform basic verifications of receivables. Okay, where he has not done the verifications. The financial statement showed receivables of rupees 10 crores. Okay, whereas actual recoverable receivables are only 3 crores. So there's a great difference. The company suffers significant loss and sues the auditor. Okay. Explain the auditor's potential civil liability. What happens from here? Civil liability for negligence. Okay. Civil liability for negligence. Civil liability may arise where the auditor has failed to exercise the degree of care and skill expected of a reasonably competent professional, and such failures causes legally recoverable loss. The relevant elements generally include existence of duty, breach of duty, negligence, loss or damage, and causal connection between the breach and loss. Application: in the given case, failure to perform basic audit procedures over a material balance may constitute negligence. So, in conclusion, we can say, subject to the applicable legal principles and proof of caution and loss, the auditor may be exposed to civil liability. Criminal liability. An auditor knowingly certifies financial statements containing materially false information after receiving instructions from the company's managing director. The auditor argues that the financial statements were prepared by management. Okay, discuss. Management is responsible for preparation of financial statements, but this does not protect an auditor who knowingly certifies false information. Where the auditor's conduct satisfies the ingredients of a statutory offense, criminal liability may arise under the applicable provisions. In addition, the conduct may attract professional misconduct and civil liability. In conclusion, we can say the auditor cannot escape criminal or professional consequences merely by stating that management prepared the financial statements. Section 447, fraud. Okay, an auditor knowingly signs an audit report containing false information after agreeing with the management to conceal diversion of company funds. Can the auditor be exposed to liability under the fraud provisions? Yes, depending upon the facts and satisfaction of the statutory ingredients. Section 447 of the Companies Act 2013 deals with fraud. Application: where the auditor's conduct falls within the statutory definition of fraud and the necessary ingredients are established, the auditor may be liable to the punishment prescribed under the Act. Conclusion: knowingly participation in concealment, diversion of funds may expose the auditor to liability under the fraud provisions in addition to professional and civil consequences. Fraud discovered after audit. 6 months after the audit report was issued, a major fraud committed by employees of the company is discovered. The auditor argues that since the fraud was discovered after the audit, he cannot be questioned. Discuss. The mere subsequent discovery of fraud does not automatically establish auditor negligence or misconduct. An auditor provides reasonable assurance, not absolute assurance, and has inherent limitations also. So application, however, the auditor may be liable if it is established that they fail to comply with applicable standards on auditing, fail to exercise professional skepticism, or otherwise breached his statutory professional responsibilities. So conclusion, we can say auditor's liability must be determined based on the audit procedures performed by him, evidence obtained by him, professional responsibility shown by him, and applicable laws, not merely because fraud was subsequently discovered. Liability to third party. ABC Bank sanctions a 20 crore loan to XYZ Limited. After examining the audited financial statements, the company subsequently defaults. The bank sues the auditor, alleging that it has relied on the audit report. Is the auditor automatically liable to the bank? Liability to third party. No, the auditor's liability to third parties cannot be presumed merely because a third party relied upon audited financial statements. Application: the claimant must establish the applicable legal basics for liability, including the relevant requirements relating to the duty, breach, caution, and loss. The auditor is not automatically liable merely because a bank relied upon the financial statements and suffered loss. So, the auditor liability to third parties cannot be presumed merely because the third party relied upon audited financial statements. Okay, the audited financial statements, depending on audited financial statements, if a third party is getting a loss, that is not automatically liable because the bank relied upon the financial statements and suffered loss. Okay, the claimant must establish the applicable legal basis for liability, including the relevant requirements relating to duty, breach, caution, and loss. Auditor's report used for special purpose. A company tells its auditor that the audited financial statements will be submitted to a bank. The auditor knows that the bank will rely on them and for a loan. The company subsequently uses the statements to obtain financing from several other institutions. Discuss the potential liability. The auditor should consider the purpose and intended users of the report and the applicable professional legal responsibilities. Liability to third parties depends upon the applicable legal principles and whether a duty of care or other basis for liability is established. Conclusion, we can the auditor is not automatically liable for every subsequent use of the financial statements, but the circumstances of intended reliance may be relevant in determining third party liability. Okay, so auditor should consider the purpose and intended users of the report. Whenever he is giving a report, he should be known and the applicable personal, professional, legal responsibilities are there. So liability to third parties depends upon the applicable legal principles and whether a duty of care or other basis of liability is established. Auditor's liability for false certificate. Say X issues a certificate stating that a company has maintained sufficient working capital. He did not examine the underlying records and signed the certificate merely on the oral assurance of the managing director. The certificate is subsequently relied upon by the lender. Discuss. A professional certificate should be issued only after obtaining sufficient appropriate evidence and exercising due professional care. Issuing a certificate without performing the necessary verification may constitute negligence and may attract professional, civil, and where applicable, statutory ingredients are satisfied, criminal consequences also. Okay. See, X cannot defend himself merely by stating that management provided an oral assurance. Okay, so auditor is liable for false certificate also. Auditor's liability and professional skepticism. During audit, the auditor noticed that the company's profit margin has increased from 8% to 28% despite no significant change in selling price, production capacity, or market conditions. Management says that this is because of better efficiency. The auditor accepts the explanation without further investigation. Comment. Auditor's liability and professional skepticism. Unusual change is an indicator requiring the auditor to exercise professional skepticism and investigate the underlying circumstances. The auditor should obtain sufficient appropriate evidence and assess the risk of material misstatement, fraud. Conclusion: mere acceptance of management's explanation without appropriate corroborative evidence may amount to failure to exercise due professional care and may expose the auditor to professional liability. So he has to be, auditor has to maintain professional acceptance from beginning of the audit to the end, and use this professional judgment to given acceptance of management's explanation cannot be appropriate evidence to failure to exercise due professional care and expose the auditor to professional liability. Confidentiality after retirement. CAP retires from the audit of XYZ Limited. After retirement, a journalist asks him about a suspected irregularity which he had discovered during the audit. CAP discloses details because he is no longer a company's auditor. The obligation of confidentiality continues even after the professional relationship has ended. The professional accountant should not disclose confidential information acquired during the professional relationships unless there is appropriate authority. There is a legal or professional right duty to disclose or disclose is otherwise permitted under applicable requirement. So CAP cannot disclose the information merely because he has retired from audit. He still has to maintain confidentiality. Okay, it is not ending with the ending of the relationship or professional relationship. Inducement by clients. A prospective audit client offers CAA an expensive foreign holiday if he accepts the statutory audit assignment. CA accepts holiday but says that the gift will not influence his professional judgment. Comment. The offer and acceptance of such an inducement may create threats to compliance with fundamental ethical principles, particularly objectivity and independence. Okay, the fact that the CA claims that his judgment will remain unaffected does not itself eliminate the threat of familiarity threat to independence and his objectivity. CA should not accept an inducement which creates an unacceptable threat to his professional obligations. Professional competence. CX accepts an audit of a highly specialized financial institution. He has no knowledge of the applicable regulatory requirements and does not consult any specialist. He signs the audit report based solely on his general accounting knowledge. Discuss. The fundamental principles of professional competence and due care requires a professional accountant to maintain the knowledge and skill necessary to provide competent professional service. Where specialized knowledge is required, the auditor should obtain appropriate competence to seek assistance from persons having necessary expertise. Say, excess failure to obtain necessary competence or assistance may constitute breach of professional competence and due care. So he has to obtain necessary competence or assistance. Otherwise, it will constitute a breach of professional competence and due care. Objectivity compromised by pressure. The management of an audit client tells the auditor that unless he issues an unmodified opinion, the audit firm will lose all assignments from the group. The auditor modifies his audit procedures and ultimately issues an unmodified opinion despite unresolved material misstatements discussed. Objectivity compromised by pressure. The management of an audit client tells the auditor that unless he issues an unmodified opinion, the audit firm will lose all assignments from the group. The auditor modifies his audit report procedures and ultimately issues an unmodified opinion despite unresolved material misstatements discussed. Objectivity compromised by pressure. The threat created by management pressure is an intimidation threat to objectivity and independence. The auditor must not allow commercial pressure to compromise professional judgment. Application: he should evaluate the identified misstatements and the effect on the financial statements and audit opinion in accordance with the applicable standards on auditing. Okay, so objectivity compromise pressure, he cannot be done. The threat created by management pressure is an intimidation threat to objectivity and independence. Okay, so we can say the auditor must not allow commercial pressure to compromise professional judgment. Application of the case, the auditor should evaluate the identified misstatements and the effect on the financial statements and audit opinion in accordance with the applicable standards on auditing. Conclusion: we can say issuing an unmodified opinion merely because of client pressure may result in professional misconduct and other liabilities. Objectivity compromised by pressure. Threat created by management pressure is intimidation. Okay, we have done this already. Management responsibility versus auditor's responsibility. The directors of ABC Limited state that since preparation of financial statements is entirely their responsibility, the auditor has no responsibility for detecting material misstatements. The auditor agrees and performs only a superficial review. So directors of ABC Limited said that since preparation of financial statements is entirely their responsibility, the auditor has no responsibility to take material misstatements. The auditor agrees and performs only a superficial review. The directors are responsible for preparation and presentation of financial statements. That is agreed, okay. However, the auditor has a separate responsibility to obtain reasonable assurance that the financial statements as a whole are free from material misstatements, whether due to fraud or error. Application, therefore, the auditor must perform the audit in accordance with the applicable standards of auditing. Conclusion, we can say management responsibility does not eliminate the auditor's professional responsibility. The auditor cannot perform a superficial audit merely because management prepares the financial statements. Management responsibility does not eliminate the auditor's professional responsibility. Even it is a duty of the management, but the auditor is also himself responsible for obtaining reasonable assurance and financial statements are free from material misstatements of fraud or error. Okay. Now, case number 50, it is a group of many cases together. Okay. Question is 8 marks question. Just for example, I'm saying CX, a practicing chartered accountant, is approached by Alpha Limited for appointment as statutory auditor. Facts observed: CX accepts the assignment without communicating with the previous auditor. He does not verify whether the appointment requirements under the Companies Act have been complied with. Alpha Limited owes undisputed statutory audit fees to the previous auditor. CX agrees to charge fees equal to 1% of the company's turnover without examining whether the arrangement is permissible. Then managing director is a close personal friend of CAX. The company gives CAX an expensive gift after the audit. During the audit, CAX discovers that the CFO has deliberately manipulated revenue. The CFO requests CAX to ignore the matter and promises to correct it next year. CAX issues an unmodified opinion. An investigation later establishes that CAX unknowingly assisted the CFO in concealing the fraud. These are all the cases, all the different facts of the case. In this examinations, 8 marks questions comes in this form. You have to answer all these parts. Okay. Advise CX regarding his professional and other liabilities. Failure to communicate with previous auditor. Under clause 8 of the part 1 of the first schedule, the incoming auditor must communicate with the previous auditor in writing before accepting the position. CX failed to comply. Second, failure to ascertain validity of appointment. Under clause 9 of part 1 of the first schedule, the incoming auditor must ascertain compliance with the applicable statutory requirements relating to the appointment. CX failed to do so. Question number 3, undisputed fees of the previous auditor. The applicable ICAI guidelines restrict acceptance of audit assignments where the previous auditor's undisputed statutory audit fees remain unpaid. CX should not have accepted assignment in these circumstances. Percentage-based fee. Clause 10 of part 1 of the first schedule, read with regulation 192, restricts certain percentage or contingent fee arrangements subject to specified exceptions. CX must determine whether the proposed arrangement falls within a permitted exception. Familiarity threat. The close personal relationship with the managing director creates a familiar threat to objectivity and independence. CX should apply appropriate safeguards to or decline the engagement if the threat cannot be reduced to an acceptable level. Sixth, expensive gift. An expensive gift from the audit client creates a familiar threat to objectivity and independence and should not be accepted when it is not clearly trivial and inconsequential. Identified fraud. After discovering revenue manipulation, CX was required to evaluate the fraud, obtain further evidence, communicate or report as applicable, and consider the effect on the financial statements and his audit opinion. Then unmodified opinion. Issuing an unmodified opinion while knowingly ignoring material fraud is inconsistent with the auditor's professional responsibilities. Then question number 9, deliberate assistance in fraud. Knowingly assisting management in concealing fraud may expose CX to disciplinary proceedings. Companies Act consequences section 145 and 447 where their conditions are met, civil liability or for loss caused, and other applicable criminal consequences. Okay, in this case, many cases were involved, so we have to likely answer all the cases according to and stating which principle and which clause is attracted. Okay, now multiple ethical and legal violations. CX conduct involves multiple independent breaches of professional ethics and personally serious statutory liabilities. They cannot rely on management's responsibility or the CEO's promise to correct the fraud later. Okay. Now we have some ICAI phrases which we can use in our answers so as to get good marks or fetch good marks. What are those golden ICAI phrases? One is that as per clause like this of part 1 of first schedule to Chartered Accountants Act 1949, in the given case the members has, okay, the requirement is mandatory and cannot be substituted by the fact that the client has considered does not itself absolve the member. 5, the member is required to access professional judgment and comply with the applicable provisions. 6, golden rule is that this creates a threat to compliance with the fundamental principles of the auditor cannot merely rely upon management representations without obtaining sufficient appropriate audit evidence. And 8, continued on the, let's see the next page. So these are the golden phrases given by ICAI to frame the answers which you're writing, so to give a professional look. Okay, the mere existence of fraud does not automatically establish auditor's liability. However, where the auditor has failed to discharge the responsibilities prescribed under the applicable standards on auditing, answer will be given in this way. If you raise these phrases, okay, it will give you a lot plus points in your answers to get the marks. Okay, now however the auditor then last 10th, according to facts and circumstances of the case, the member would or would not be guilty of professional misconduct. But in this way, if you phrase your answers, you're going to fetch more marks. Okay, now last minute priority chat for your November 2026 examinations. A plus miss, which is having the highest priority. Communication with previous auditor, clause 8. Appointment compliance, clause 9. Unpaid audit fees, percentage of contingent fees, clause 10. Fraud and auditor liability, sections 140 subsection 5 and 447, civil versus criminal liability, independence of financial interest, and advertisement or solicitation. These are the A plus zone where questions will arrive from the highest priority basis. Then A, non-executive directorship, other business or occupation, fee sharing on commission, confidentiality, conflict of interest, gifts or inducements, professional competence, management responsibility versus auditor responsibility. Then B, third party liability, liability for certificates. Okay, now the strategy which I'm going to say is that recommend marks allocation. However, the 4 marks case question is there, then 1 mark goes for the provision, second 1.5 for the application to the facts of the particular case, and 1 marks for a conclusion. Okay, and correct statutory or professional reference. If you give the perfect answer, there you get the full score. Okay, 5, 6, 7, 8 marks if there are questions of the provision. First write the provision, then write the explanation, then give the facts of the particular case and apply to the case, then consequence and conclusion derive after that. Then you can face a great marks from each answer. Do not memorize conclusions alone. This practice examiner style situations rather than only define or explain questions. Okay, always do any question first, write the provisions, then to the application case, what are the consequences, and then come to the conclusions. Don't write a history of that. To the point, give the points. Okay, answers. Study guidance, I will give you always use the applicable ICAI study material, because ICAI study material is your main book which you have to follow to get good marks. If you really want to score above 60, above 70, you have to follow, go through the ICAI study materials, case scenarios, booklets, and RTP MTVs or case scenario materials, suggested answers, and concrete list or professional updates together rather than relying on a single capsule or I will say any notes, whatever you follow, but you should follow the ICAI study material, the RTPs, case scenarios, everything which is given, provided by the ICAI. Okay. These 50 questions I'm giving high probability of coming. It's not that you will go reading these 50 questions and from here the only professional ethics are going to come, but the probability of these questions is coming from the fact that they have been the concept, they have repetitions. Okay, and from your RTPs and MTPs it proved to be the higher goal. Since the advertisement has a change, so the question of advertisement by a CA, it can come. So there comes a probability of coming in this examinations. So very a good I'm just giving you a lot of best wishes to complete the course and write your answers in the form which ICAI wants you to write, and hope you all can score above 70. Thank you.